Hi, everyone. Today I'm going to talking to you about the S&P 500 Index. The S&P 500 Index is a stock market index that includes the 500 largest publicly traded companies in the United States. It is a very popular benchmark for American markets and is used to measure the performance of the stock market as a whole. The index is based on market capitalization, with larger companies having a higher weighting. The companies in the index are selected by Standard & Poor's and must meet specific financial and liquidity requirements.
What can be the advantages if we invest in the S&P 500? Diversification. The S&P 500 includes 500 large publicly traded companies, providing investors with broad exposure to various industries and sectors. This helps to reduce the risk of investing in a single company or industry. Lower costs. Investing in an S&P 500 index fund typically has lower fees and expenses compared to actively managed funds, which can increase long-term returns. Historically high returns. The S&P 500 has a long history of strong performance, with an average annual return of around 9 to 10% over the past several decades. Convenience. Investing in the S&P 500 index is simple and requires little to no effort, making it a convenient option for busy investors. What can be the disadvantages if we invest in the S&P 500? Market risk. The S&P 500 is a market-weighted index and reflects the overall performance of the U.S. stock market. As such, it is subject to market fluctuations and can be affected by economic, political, and other factors. Lack of control. Investors in the S&P 500 index have no control over the companies included in the index and the allocation of their investments. Potential for underperformance. While the S&P 500 has a long history of strong performance, there is no guarantee that it will continue to perform well in the future. There may also be times when the index underperforms compared to other investments. Limited exposure. The S&P 500 only includes large publicly traded companies in the U.S. and does not provide exposure to smaller companies, international markets, or other asset classes. There are several reasons why investors may choose to invest in the S&P 500 index. Diversification. The S&P 500 includes 500 large publicly traded companies from various industries and sectors, providing investors with broad exposure to the U.S. stock market. Historically high returns. Over the long term, the S&P 500 has delivered strong returns, with an average annual return of around 9 to 10% over the past several decades. Low costs. Investing in an S&P 500 index fund typically has lower fees and expenses compared to actively managed funds, which can increase long-term returns. Convenience. Investing in the S&P 500 index is simple and requires little to no effort, making it a convenient option for busy investors. Trusted benchmark. The S&P 500 is widely considered to be a leading indicator of the U.S. stock market and is widely used as a benchmark for the overall performance of the stock market. Access to blue-chip companies. The S&P 500 includes some of the largest and most successful companies in the U.S., providing investors with access to well-established, financially sound companies. Investing in the S&P 500 index can be a good option for long-term investors seeking to build a diversified portfolio with a focus on U.S. equities. However, it's important to keep in mind that investing in the stock market carries risk and past performance is not a guarantee of future results. Investing in the S&P 500 index carries several risks, including market risk. The S&P 500 is a market-weighted index and reflects the overall performance of the U.S. stock market. As such, it is subject to market fluctuations and can be affected by economic, political, and other factors. This means that the value of an investment in the S&P 500 can decline in response to changes in the market. Company risk. Although the S&P 500 includes 500 large and well-established companies, the financial performance of individual companies can still be subject to significant fluctuations. This can result in fluctuations in the value of an investment in the S&P 500 index. Interest rate risk. Changes in interest rates can affect the value of stocks in the S&P 500, as well as the overall performance of the index. Rising interest rates can make bonds and other fixed-income investments more attractive, leading investors to sell stocks and reducing demand for equities. Political risk, political events and decisions can also impact the stock market and the performance of the S&P 500. For example, changes in government policies, trade tensions, and other geopolitical events can all affect the stock market. Currency risk. For investors outside the US, changes in currency exchange rates can impact the value of their investment in the S&P 500, as the value of the index is quoted in US dollars. It's important to keep in mind that investing in the stock market carries risk and past performance is not a guarantee of future results. Before investing in the S&P 500 Index, investors should carefully consider their investment goals, risk tolerance, and financial situation. I will also tell you some little-known tips to help you invest in the S&P 500 Index. First, consider dollar-cost averaging. Instead of investing a lump sum all at once, consider investing in the S&P 500 Index through dollar-cost averaging. This means investing a set amount of money at regular intervals, regardless of the market conditions. This can help to reduce the impact of short-term market fluctuations on your investment. Second, rebalance your portfolio regularly. Over time, the composition of the S&P 500 Index can change, and the weighting of different industries and sectors can shift. To maintain a well-diversified portfolio, it's important to regularly rebalance your portfolio to ensure that it remains aligned with your investment goals and risk tolerance. Third, consider tax-efficient index funds. If you are investing in an S&P 500 index fund, consider choosing a tax-efficient index fund, such as an exchange-traded fund, ETF, or index mutual fund that uses tax-efficient strategies to minimize the impact of taxes on your returns. Fourth, avoid timing the market. Trying to time the market and buy or sell based on short-term fluctuations in the market can be a risky strategy. Instead, consider investing in the S&P 500 Index as a long-term investment and stay invested even through market volatility. Fifth, consider the overall market conditions. Before investing in the S&P 500 Index, it's important to consider the overall market conditions, including economic indicators and geopolitical events that may impact the stock market. Remember, investing in the S&P 500 Index carries risk and past performance is not a guarantee of future results. It's important to do your own research and consult with a financial advisor before making any investment decisions. Well, that's all I have for you today on the S&P 500 Index. I hope you found this video helpful and now have a better understanding of this important stock market index. Thanks for watching and have a great day. Subscribe to the channel to see more from the investment world.